Hello and welcome. You're watching Investing Channel. I'm Charlie Gibson. I'm a head of mining research at Edison Investment Research. And today I'm talking to you about precious metals. And the first thing I want to dispel is a notion. And in particular, when we talk about precious, what we tend to do is we tend to talk about gold, and then we talk about some of the other metals which perform in some ways a little bit like gold. So we talk about your platinums, your palladiums, and your silvers. But one of the things they always say about gold is that somehow it should be held in a portfolio as though it were some sort of insurance policy, something that's inversely correlated with other markets and other indices, and therefore that gives you a level of protection when everything goes wrong. And I just want to show you one chart up here, first of all, just to begin with, just to set the scene. And that shows the gold price against the Dow Jones index since 1968. And what you will notice there is that over that pretty considerable period of time, what is that, 51 years, the gold price has, in capital terms anyway, outperformed the Dow Jones. Now, the margin by which, if you were to do a compound interest rate over that entire period of time, you would see that the gold price had outperformed the Dow Jones by about 3% on average per year. And now, of course, the purists amongst you will immediately say, yes, but the Dow Jones pays you a dividend. Over the same period, the Dow Jones will have paid you roughly a 3% dividend on average over that period of time. So on that basis, you would still find that the performances of the gold price against the Dow Jones, that basket of stocks, US stocks obviously in US dollar terms, you would have found that the performances would be about the same. And what I want to say is that over the long term, that is a pretty impressive price performance that is for something that is always considered to be something of an insurance policy. Now, the question is, where is the gold price going to go? And now, someone once very cleverly said that history may not repeat itself, but it certainly rhymes. And in my second chart here, what I want to show you is a bit of what I think is rhyming history, if not repeating history. And what that shows you is real interest rates between, for two periods, for two cycles. And the blue line, the real interest rate, is from 2004 to the present. And for the orange line, the real interest rate is for 1970 to 1981. And what I want you to notice here, these are two crises which, in my opinion, are almost exactly the same, except for one has been stretched out. Real interest rates for these purposes are Fed funds less the US CPI rate of inflation. And what I want you to notice, at the beginning of both of those periods, there is a small negative real interest rate. And that corresponds to the recession, the mild recession in the early 2000s, and also the mild recession in the late 1960s, 1969. And then what you see is those real interest rates begin to go positive, and then there is a colossal crisis in 2008 and in 1974, colossal crisis, and real interest rates go very sharply negative. And that you can see happening around about 50 months into that graph. Then you see the recovery as the Federal Reserve, in this case, tries to bring real interest rates and actual interest rates up to something close to zero. Now, what you notice is that the 2004 to 2019 line is very, very stretched. So it's a much longer cycle relative to 1970 to 1981. But what you see is that after interest rates have normalized at about 100 months, you get this sudden period of extreme volatility in the 1970s. That corresponds to 1979, 1980, and we haven't yet gone through that. And that is the point at which the gold price peaks. And you don't actually see the gold price going down until real interest rates hit 4% or higher, and that's when the gold price will peak. We're nowhere near that this time round, so that is why I think that gold is a good thing. Very quickly, if you want a geared effect to gold, then look at the silver price. This is the gold-silver ratio, and whatever else happens, you can see that it's at very high ratios. At some point, that's got to come down. So that's my prognosis for precious metals over the next few, certainly months, if not years. We look forward to bringing you more such opportunities in the near future. This is me, Charlie Gibson, signing off. You have a capital day.